Hello everyone and welcome. Advanced moving averages for today, a bit more complex, we could say, a bit more actually based on different setups of moving averages. You could strengthen more your existing moving average setup and MT4 or MT5 setup in general based on your trading strategy and etc. So today we're gonna see combinations of moving averages along with some with a deviation in their setups as well, in their settings. So as usual, I need to go through the disclaimer warning. Please don't hesitate to let me know whether you can hear me loud and clear and see my screen as well. I would like to remind you that this webinar is recorded, so you're gonna receive in your email a recording of this session, and we're good to go. Disclaimer: this material is provided as general marketing communication for information purposes only and does not constitute an independent investment research. Nothing in this communication contains or should be considered as containing investment advice or an investment recommendation or a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in leveraged products is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk, for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Risk warning: trading leveraged products such as forex and derivatives may not be suitable for investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risk involved, take into account your investment objectives and level of experience before trading, and if necessary, seek independent advice. Okay, guys, we're good to go. Feel free to ask anything you want in our question box, okay? Webinars@hfm.com, it's our email address. Feel free to ask anything that you need, not regarding the webinar only. In general, if you're struggling with your strategy, if you cannot see what you're doing wrong, if you need any assistance from analyst, please feel free to take some screenshots, compose your question on the email and send it to us. Me, Michalis, Francois, Dennis, all the analysts of HFM, they will be more than glad to reply to your question and to help you further, okay? I would like a feedback regarding the audio, guys. Are you with me? Are you can hear me? Okay. Anyone? Okay. Thank you, Martin. Advanced moving averages. How many of you are beginners, newbies? How many of you have never used moving averages? Which I don't think that's the case. Just to have a sense of the audience over here. Just to no? Anyone? Don't know whether the replies are just we have some late replies or delay or something, but okay. I see. Okay, very briefly, what moving averages are, okay? Basically, dear Hilton, I can see that you are new here, so don't worry about it. Moving averages is exactly as what the names means. Basically, is an indicator that takes its basic function is to calculate the average of the data, okay, and create a series out of them. So creates, so you know, let's say that we are in a 4-hour chart, for example, and our moving averages is a 20 period moving average. So what that means, it will calculate and find the average value of the previous 20 4-hour sessions, the average level, the average price based on the previous 20 4-hour sessions of the last 24-hour sessions. So by calculating at every new slot a new average, then it connects these levels with a line. Okay, a natural complement to any time series interpretation. This is what a moving average is. Remember, like in other purposes, okay, I cannot think anything meaningful right now, but moving average, it's a like every single other time series interpretation, can smooth out, okay, the noise. This is what it does also in the in our charts, in our price charts. It smooths out the noise of any random outliers and emphasizes in the trends. So it's another technical tool. Moving average, I think, is something that is used from everyone, technical analysts, long-term traders, short-term traders, investors, stock market traders, commodity traders, from everyone. Simply because it smooths out the noise. It's giving us the moving averages, right? So what is a moving average? Remember that the moving average, okay, by finding the average value of an asset over a given period, is like we are finding the value which it tends to return, right? So that's why they are so meaningful, because they have a lot of applications. That's why they are widely used as well. It can be applied in many different ways and for different purposes. So if someone, I think like every single other analyst, if we had to choose not our favorite one, but to choose out of many, the one that is the most reliable one, that would be the one moving average, like the fundamentally, like the father of indicators, because all the other indicators, they are based on moving averages as well. Remember Bollinger's, remember even the regression channels are based on moving averages. Okay, there are a lot of indicators that as one of the within their calculation, they also consider the average value of the asset. So just to clarify at this stage that it is a lagging indicator, simply because it's based on the past value. Okay, so it's based on the past values, such as the high, the low, the open, or the close prices, or even sometimes it could be applied even to the volume. That's why it's a lagging indicator. And the number one advantage is what I initially said, that it smooths out the noise that it can be created by random price fluctuations because something happened out there, breaking news, something in the politics, data release that had caused a significant price fluctuation. So there are only, I mean, as I said, it might be the most reliable indicator that there is in the industry. So the fundamental assumption of technical analysis holds that past performance can inform future movement. Remember that? Similar to the history, also the market repeats itself. That's why it's significant to check the past performance before we take any decision. And this is why moving average play a central role in the determination of the past price trends, simply because the prices of assets, in general of securities, the value of the indices are volatile, right? And unpredictable sometimes. So our tool, your tool as traders, is to reduce as much as you can the risk and increase the likelihood of profiting, right? So the fundamental assumption of technical analysis holds the past performance and can inform with this, by holding the past performance, can be very helpful on identifying future movements. Okay, that's why a moving average could be very useful. Okay, the basic ones is the simple and the exponential moving average. However, we're gonna see together some more advanced ones, such as the variable moving average, the weighted one, the centered one, the adaptive one, Hamming one, and etc. There are many different kind of moving average calculations. Okay, okay, all of them obviously are used to plot a line against either a price chart or another indicator. So regardless of which moving average you're using, the goal is one. The goal is to have a line being plotted, and the direction and the slope of this moving average line will help us finding out information regarding the relationship between the historical data value of the asset and the present data value of the asset. Okay, so using the moving average, we can spot divergence, we can get confirmations, we can find out whether we are in an overbought or oversold condition, we can identify support and resistance levels, and many others, many other useful actually useful sides of the moving averages. So let's start with the simple one. Simple is the simple moving average is an arithmetic moving average, as you can see from the calculation over here. A1 plus A2 plus A3 plus over the given number of time periods, which gives us literally the average value. Okay, this is a very simple, the simplest moving average that there is out there. Basically, by adding, first adding the closing price for a given number of time periods, and then dividing that sum by the same number of time periods. So we're gonna have either a simple positive or negative trend in order to give us an overall picture of the market. The larger the time period, the less volatile the simple moving average will be. Okay? There are a lot of traders that are skeptical about the simple moving average. I know that some of you might be skeptical around it because there is the belief that the most recent data carries the most weight and importance, because simple moving average considers all closing price equally. But that is something that you need to identify in practice by applying firstly the default one, which is the simple moving average on your charts, and you see that it doesn't give you too much weight and importance. Then you can move on and try exponential or alternative moving average to find out the one that suits your asset and your time zone better. So the second one is exponential moving average, which is a type of a weighted moving averages. So it's basically the difference between that and the simple moving average is the fact that the exponential moving average it places greatest significance on the most recent data points. So the simple moving average is just taking all the data and finds the average value, right? Without particularly emphasizing on the latest or on the first ones, the old ones, etc. It's just equally taking all the previous data and finds the average value. Now, the exponential moving average, though, okay, even though it takes into consideration a set of data, okay, it places greatest significance on the most recent data point. Okay, so I have put on the mathematics behind it, but you don't need to remember the formula, just to understand that it's a more weighted one. So it takes into consideration, basically it emphasizes on the latest data. So if it's a 20 period moving average, for example, it will start from the very first one up to the 20th, but it will the last ones, so 17th, the more we move on, so the second will be more significant than the first, the third will be even more significant than the second, the fourth will be even more significant than the third, and go on and so on, go on. It's like exponentially. So that's why it tends to be, and it is actually, a more reactive to the recent price changes than a simple moving average. Okay, let me just bring also my platform on so you can see very briefly the difference. Oops, wrong. Okay, over here we had a gold, but okay. Okay, that's a 10 moving average, okay? 10 moving average. 10 simple moving average actually is not good for our 2-hour gold price. Okay, let's ignore that. That's a 20-day moving average, okay? A 20-period moving average. This is the simple one. If I change the simple into an exponential one, you can see that it came closer, even closer to the price action. Okay, this example is not ideal because none of them, the setting is not correct. Okay, let me see. That's the 20 exponential. No, it should be even higher. Let's put the 70. That's is looking like a much better one. It provided a nice support, retested here, retested, and didn't broke it. It's not a great resistance right now, but it's just to distinguish between the simple and the exponential. This is exponential one. If I change it into a simple one, you're gonna see that it will move in a not as smooth as the previous one, a bit more in a distance, so not time sensitive, not ideal for at least intraday setup. Just okay. 100 simple and 100 exponential one. Okay, so the exponential, it gives you, as I said, it's a more weighted one, so it gives you earlier any sudden shift in the price movement. So it's useful for that exact purpose. It's useful to help spot sudden shifts in the price movement because it gives signals earlier than the simple moving average. Okay, so the benefit using the exponential rather than the simple one is exactly for that reason, because it can help, it has the potential to help you avoid missing the optimal point to open or close a position. However, there are obviously the disadvantages around the exponential moving averages, such as that they are less accurate than simple moving average when charting long-term trends. So exponentials are very useful for intraday short-term time frames, while simples are quite ideal for long-term, such as daily, not even weekly and monthly. Okay, so if I had to, here is the daily, okay, daily one. And let's use the 50 simple moving average first, okay? Comme ci, comme ça. Comme ci, comme ça. This is the 20 exponential. Which is not bad at all, actually. 20 exponential provided an imminent support. Imminent support right now is retesting it again and again. This is the 20 exponential moving average. So if we see a consecutive, a breakout of the 20 exponential moving average and a move below it, that could indicate a pullback for gold. If I put the simple though, we could see that according to the simple, the price is already below the moving average. So it's giving the indication that a downtrend might already happen. But is this accurate? Question mark, because this is still flat. So in this case, the exponential satisfies much better the daily chart than the simple one. Okay, because it gives still it satisfies this consolidation that we have seen for 6 consecutive days. Okay, weekly. Here we are, far away. A little bit closer. So it gives you an imminent, more imminent. If you're chasing for a closer support area, then you will use exponential. If you're a long-term trader, you just want a clarification for a long-term target, then you could use simple as well. Okay, so simple generates positive or negative trends to give traders an overall picture of the market, but with the exponential, guys, it can help you actually finding the optimal point of entering a trade or even closing an existing trade. Let's move on. Now, some of the crossover rules. Okay, moving average crossover rules. Have always in mind that long-term trading signals can be generated on the basis of moving averages crossover rules, okay? So in this case, a short-term moving average as a short-term moving averages crossing above, can you see my cursor? No pen cursor, okay. So if we see a short-term moving average crossing above a long-term moving average, that's an indication of a bullishness. That's a buying signal. If we see a short-term moving average crossing below the long-term moving average, that's an indication of bearishness. What I mean by above or below, a cross above or below. So here, for example, regardless if we are using simple or exponential moving average, okay, regardless of that, if you have used for your analysis 2 different settings, so let me just, okay. Here we have the 20 already, and let's put a 51 as well with blue. Okay, so we have two moving average, but with different period. Same method, same applied to the close prices, but different period. So if the short-term one, which is the 20, is below the 50, which is the long-term one, that's a bullish signal. If the 20 is below the 50, that's a bearish signal, okay? As you can see, this signal looks a bit delayed. So in this case, I'm gonna use an even shorter one. I'm gonna use the 10 and the 20. That looks just fine. So we got a buying signal much earlier. Here it was. A sell signal here, perfect. See? And so on and so forth. So another buying signal here. And it's still both pointing to the upside with a widened gap, indicating that there is further room to the upside in the long term at least. So this is the #1 rule when you are using the same moving averages, either simple or exponential or weighted or smooth or variable ones, whatever indicator you use. If you use, however, for the same moving average, different periods, so this is the most important rule. Okay, obviously you cannot have an exponential and I don't know, an exponential and a smooth one. No, you will either have both smooth or both exponential or both simple or both linear weighted, okay? So the rest of the sentence should be the same, only the period should change. Okay, in order the crossover rule to be proper, to be interpreted properly. Okay, so also another important rule, okay, is the bouncing. Okay, is the bouncing. So a simple moving average bouncing up off a long-term moving average. So a short-term moving average bouncing up a long-term moving average is another indication of bullishness, while a short-term moving average rebounding down of a long-term moving average is an indication of further bearishness. So that's why the gap also matters. If we're seeing, because the gap, the biggest the gap gets, the more the indication of bouncing up or inbounding down and so on and so forth, okay? So this is an indication, and you see that the gap is getting wider and wider. This is an indication that the bullishness will continue, that there is further room with bulls, the further room to the upside. There is more, there's still a lot of bullishness around this asset. While if we see the moving averages flattening, oops, what's going on? What's going on? Come on, up. Sorry, guys, just a second. Something is. Hello. Hello. Can everyone hear me? I've lost one of my screens. Sorry for that. Okay, we are back. Let me again continue to. Okay, perfect. We are back. So now I was ready to show the it's sorry, everything. Sorry guys, sorry, I'm facing an issue over here. Okay. Also, flattening moving average is an indication of consolidation, so you need to be very careful with it as well. An example was over here. You can clearly see that for a while we could see the moving average flattening. That was indication that there is a lot of indecision and there is no clear guidance on whether the asset will have an uptrend or will develop a downtrend, until eventually everything became clearer by this rebound and this morning star formation over here, which it was the beginning of a new uptrend. So flattened moving average is an indication of consolidation. Okay, now slope. So you need to be careful whether you have seen a crossover, whether you have seen a bouncing up, a rebounding down, a flat moving average, but also to check the gradient. A steep slope suggests strong momentum. A narrow slope suggests a weak momentum. That's why if the moving average are flattened, indicates consolidation. So the steeper it gets, the higher the momentum gets, the stronger the momentum gets. Okay, the more the stronger the trend is. So let's move on because we spend a lot of time on the basics. Okay, this is an illustration and actually an illustration of, in order for you to understand the slope, okay, the gradient, how important the gradient is. Can you see that? The best angle of climb in an airspace gives the greatest altitude gain in the shortest horizontal distance, while the best rate of climb gives the greatest altitude gain in the shortest time. Okay, the steeper, the strongest, but short-lived. The gradual growth, it means that it might take longer to reach the same level as if it was in a steeper slope. So it's like the Eurotonics. That's why we have this illustration, because the rate of the angle of climb matters. Let's move on. See them a bit more complex ones. Okay, I'm gonna move on because we've wasted a lot of time on the basics and I haven't really shown yet the more advanced moving average. Okay, so I'm gonna leave this for you to check them out later on. Okay, but what I want you to emphasize on is also the distance between the price action. Something that also you have to measure is to check the distance between the moving average and the price action. Have in mind that the volatility is measured by taking the distance of the price action between the price action and the moving average. Okay, as you can see from this chart over here, as the moving average moves away from the price, it indicates higher volatility. So you see over here that we have a huge distance between the moving average and the price action. That indicates an increased volatility, a really high volatility in the market. So the far away it gets, the more the volatility gets. The closest it gets to the price, the lower the volatility is. Okay, so this is the concept of mean reversion as well. Okay, mean reversion is the concept that is primarily used in statistics. So this is a field of study where a variable is set to revert to its mean value over a period of time, right? That's why moving average could be very useful as support and resistance level, because based on the mean reversion concept, also the price will eventually revert to its mean value after a period of time. It's the same as in statistics. So in the financial market, the very same concept can be applied. Whenever price deviates too far away from its mean, like here, so way far away, the price is way far away from the mean price, which could be seen using the moving average, then traders can take advantage of this phenomenon and find some further trading opportunities based on that. I know that this sounds a lot of theory, but you need to understand this concept. You need to understand the meaning of mean reversion, because mean reversion is predictive in nature. So this brings the risk that price can remain at this extreme value of prolonged period of time. And this has as a result the chance of a trade going bad is quite high actually. Okay, so whenever the price deviates too far away from its mean, you can use this. You can stay away a bit until it calms down a bit and it comes closer to the mean in order to have a more proper approach, to find an appropriate approach, because such a volatility could be easily, quickly reverted and get back to the upside. So you need to wait until the price and the moving average are in line again. Remember that the markets are random, so there are many examples where the price of a security continues to remain at one of the extreme levels. So check the volatility, check the distance between the price, and if it's far away, wait for the noise to get out of the market a bit before you decide whether you will open a position along the trend or whether you will wait for further confirmation of based on the direction of the moving average. Now. Okay. Okay. More advanced moving average. Actually, more advanced moving average is the smooth one and the linear weighted, or by using your existing simple and exponential moving averages as well, but changing by changing though some other parameters such as the shift, such as whether it's applied in the close prices, whether it's applied on the weighted close, whether it is applied on a particular indicator, whether it's a double or triple smoothing moving averages. So there is a lot of choices out there, but you see, it could be a simple moving average, for example, could be applied on the close price solely, or the upper price solely, on the median price between the high and the low, on the typical price, so take into account the high, the low, and the close price, the weighted close, okay, or based on a moving average based on the indicators data and not the price action. So there are all these options available, but you should be very careful with it. It doesn't mean that you need actually to practice a lot, change, check all the options, and to find out the one that is providing the highest accuracy on your particular time frame and particular asset. It's clear that simple moving average assign equally weighting to all values. It's clear the exponential moving average it gives a higher weighted to recent prices, so that's why you should use it for intraday setups. While if you are a longer period trader, you need to consider smooth moving average. Why? Because it gives the recent price an equal weighting to the historic ones. This is for a long-term traders. So if the price is above the smooth moving average, you buy. If it's below, you sell and liquidate that position when the current price closes below either moving average. But this is for a long-term traders. Now, the difference between mid-price option, typical price option, and weighted price option. Okay. First of all, I have put, let me just, okay. I have put a table, okay, over here, using the weighted moving average, okay? So weighted moving average, guys, is similar to the exponential one, but it adds greater weight to the more current data points. Because the concept behind it is that they are more relevant than data points in the distant past. So the sum of the weighting should add up to 1 or 100%. So in the case of simple moving average, the weighting are equally, okay? But in this one is the most relevant ones that have the heaviest weight. And you can see over here a 5-day weighted moving average, the sum of the days as well, okay? The prices, the weighting, the weighted value as well, and what that resulted. But I know that it doesn't make sense as soon as you see it actually visually. So here is the difference between the weighted moving average and the simple moving average. So very, very similar with the exponential one, but is even more sensitive than the exponential one, even more sensitive, okay? So so it's ideal, we could say, for if you need urgently to find out a more immediate support and resistance level, or if you are using it for a short-term trading as well. It could be also it is also applicable into a medium and long-term trader, such as daily and weekly, but you need to change the period of it. But weighted could be very useful for scalpers, okay? Because it's adding, as I said, more weight on the recent data and less to the past data. So this is done by multiplying each bar's price by a weighting factor, like in the, here is the weighted factor. Here you can see the third line. Where's my cursor? So this is the weighted ratio, let's say, the weighted factor. So it's a very unique calculation, and out of the three most famous moving averages, such as the simple, the exponential, and the smooth one, the weighted one is the one that follows prices more closely than the other three. So how to use weighted close indicator? So basically, because it's as sensitive, it's the most sensitive one, okay? It gives a very, it could be used actually for spotting entry levels, okay? So because it provides a more sensitive and time urgent signals. So usually the traders that use the weighted moving averages, they use it for taking an entry, okay, for taking an entry, and in general, and the overall, the long-term traders they using it for timing their entry as well. Obviously, it needs to be combined with another indicator, either with it might be a trend line, it might be a chart pattern, it might be what else? It might be an RSI as well, but it needs to be combined with at least one more indicator. Or it might be, like in this case, a second moving average, but in a different form, like the simple moving average one. Okay, in order to time out the entry, but also having an appropriate entry level. You see the crossover rule over here. Here, the weighted moving average, the rebound that we are seeing, and the move towards the simple was a nice indication of closing the pre-existing long trade. So with this way, by using two different moving average, you are timing your entry in a more accurate way. See, entry, right? Exit as soon as you see your weighted moving average pointing towards the simple moving average. If they move in line like here, that means that there is further room to the upside. But if at some point, let me draw it, if at some point you see the weighted turning, doing this pullback like that, that's an indication that is coming to cross below the simple one. Okay, so that will be a firstly indication to close a long entry if you had one. Secondly, to start looking for potential short entry. Also, okay, this is the same as the previous example. Weighted moving averages experiencing more whip swaps than simple moving average. That's why it's better to combine both. Okay, to combine both. But can you see that the bullish signal, the weighted moving average gave a bullish signal much earlier than the crossover? The crossover over here gave the confirmation, but the very first bullish signal came as soon as the price action moved above the weighted moving average. That was the very first indication of a possible uptrend coming up. We had the gap up, sideways, 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 and as soon as we got the crossing, we were good to open an upwards, a long-term, to go long basically on this asset. Okay. Now, what else I wanted to cover? So by default, the moving averages are based on the close price. Okay, you remember that? It's the most common setting, the default setting that you're gonna see in your platforms. As I said earlier, you can either change it to a weighted close, like the examples that we presented earlier, or you can change in general the method. You can use weighted moving average, you can use simple moving average, you can use smooth ones, linearly weighted, etc. But other than the actual method, you can also change the which data is using. By default is the close. So the same is on the requirement for you to change the settings. Okay, it depends what you want to achieve by changing the prices. If you want something more sensitive and more if you are a very short-term trader, for example, and you want possibly faster signals, but you might with this way you might risking to get false signals as well. You might try these ones, these three, the media price one, or the typical price one, or the weighted close one. They will give you a more precise moving average, because they take into consideration not only the close price, but they find the moving average of the high and low of the previous high and low. Okay, so you can either use that, or you might consider taking the high, the low, and the close. So you're changing actually the input data, and that will have a direct impact on the profitability of on them. Basically, it will make your indicator even more precise. That's why you need to be very careful about it, but it might satisfy quite well assets with if you have basically if you are a trader that uses trades a minute chart, 2 minutes chart, 5 minutes chart, you might consider checking these options as well. This is not a requirement, okay? It's some just alternative input data that could have a direct impact on the profitability of the of these trade signals that we talked about. So for example, let me zoom in. Okay, this one, the red is the default one using close prices, and the higher one using using high price. So you might want to have a resistance zone and a support zone. Okay, so you can use this kind of format if you want a zone and not a single support and resistance level. If you want an area, a support area, and a resistance area, then you can use close and high prices, or if you are in an uptrend, close and low prices. With this way, you're getting a support area instead of a single support level. Here we have three different moving average, all exponentials, but one is based on the high prices, the other one is the default based on the close prices, and the third one is based on the low prices. The reason for that is because I was aiming to have 3 layers of support and resistance levels. Okay, so only with this way I'm gonna have the very first indication of we could either you can either take multiple trades based on where the price action stands, or with this way, you can use it for setting sorry, multiple exit levels. What I mean, so this is an uptrend, right? And we have these three moving average act as three different support levels. Support number 1, support number 2, support number 3. Okay, so you might say, okay, I'm in a long position. So as soon as the price kicks the first moving average, so the blue one, okay, as soon as, not only kicks, but as soon as it closes below the first line, close the 50% of my existing position. As soon as it closes below the red line, close the remaining 30% of my position. And as soon as it closes below the green line, then close the rest of the 20% of this position. With this way, you are locking profits, having multiple exit levels. Or with this mentality, with this concept, you can take multiple positions. So here, it peaked over here and start slowing down, pulling back until it crossed below the first moving average. So you could take a short position here with this entry. As soon as it moves further lower, breaking the next level, the next support level, you can add on that short-term position. And as soon as it confirm a close below all three moving average, you could add for one more time into your short position. And as it moves below the moving averages, you can use this moving average as your trailing stop, your trailing stop loss as well. Okay, there are multiple ways to use these moving averages. Or another way is to enter at as soon as the price is above all of them. Okay, so basically when the price closes above the moving average, which was based on the high prices, so you will take an entry there and exit as soon as you see the price closing below the moving average that it was based on the low prices. That's another simpler approach. Okay. Now, a more complicated one, but very, very useful. This is a very old example. Okay. A long-term example, but it doesn't matter. It's the concept behind it and how it works that you need to think about. Okay. So, over here we have, as you can see, 1, 2, 3, 4, 5, 6 different moving averages. All of them are exponentials. The two are in an 8 period. They are 8 period moving average, and the other 1, 2, 3, 4, the remaining 4 are based on 10 weeks period. The difference between this moving average is mainly the input data. So with yellow is the monthly, sorry, a bit complicated one. Is with yellow, the yellow takes into consideration the monthly. the yellow, the green, the yellow, and the red are monthly moving averages. So yellow shows 10 months moving average, 10 months moving average. The green is 8 months moving average, but based on the low values. And the red is 10 months moving average, but based using the high prices. So these are the more long-term moving averages. The short moving averages is the other three. So with gray, we have 8-week moving averages with input the low prices, the lowest prices. The light green is the default one, closest prices for the last 10 weeks, and the purple, that's the purple is pink. We have the 10-week, but using the high prices. So with this way, you have multi support levels and actually multiple crossovers as well. Okay, so this is a more complicated. It can be used for people that they are more long-term ones, because with this way they can take entries for a medium-term entries, but they can also take long-term entries in a single chart. This cross of the 10 months red line below the weekly ones was a clear bearish indication for the beginning of a new downtrend that will last for more than a year. So this is how the big boys using this kind of complex moving averages. So I know that it looks messy, but the fact that the 10 months line over here cross the 3 weekly moving averages over here, it gave the confirmation that there will be a long-term downtrend that will last for months or even years. So this is how long-term traders using in a single chart long and short-term moving averages using the default input, the high prices input, and the low prices input. How you can change it on your time frames, and if you're scalpers or intraday traders, same concept, but you can apply, let's say if you are in 1 hour chart, for example, okay, you can use 2 or 3 moving averages for the 1 hour chart. So you can use 10 period with close prices, 10 period with high prices, 10 period with low prices, with high, low, and default. And you can also add another 3, same settings, so high, low, close, but for the 4-hour session or for the daily session. It's up to you. Just check something. So here you can choose the time frames. Or where you want it to be shown, and etc, etc, etc. Okay, this is a 20-day exponential moving average as well. Basically, with this one, we have used a 21 exponential moving average, and we have used also a daily median price moving average. So you can see that the one is giving us the mid of every day's session, and the other one is a more long-term one, which it just illustrates the overall direction of the trend. The helpful one though is the daily media one, because you can see that the asset is below the mid price, so that suggests further move to the downside. While as soon as the price gets above its mid price, that suggests that we're going to have a rebound. Another example, using the typical price indicator, basically simply an average of each day's price. The median price and the weighted close are very similar indicators. The typical price indicator provides a simple and single line plot of the day's average price. So some investors use the typical price rather than the close price when creating the moving average penetration system. The typical price is a built-in block of the money flow index. So this chart shows the typical price indicator on top of the value lines bar chart. You see, the price daily, right? The median line and the weighted, is the typical price line. Plotted along with a simple one as well. So at every crossing, you can take an entry. Long entry, short entry, long entry, short entry. So it's quite nice for intraday fluctuations or for some short-lived fluctuations even in the daily chart. So for example, that was a clear long position entry, right? But since then, since here, it never crossed again the blue line, so the simple moving average. Okay, until it crossed it somewhere here, not cross it, touch it. So here you could consider either closing your existing trade or taking a shorter, taking another short-lived long one, okay? Because it didn't cross below it, it just clashed. So that was indication of closing for short the existing long entry and considering taking a short-lived long entry, or just to stay out, to exit completely. As soon as it crossed, however, the blue line, you could consider taking a short entry here, or if you needed further confirmation, you could wait until it confirms a move below the blue line, which is an indication of a clear short position. But you can see on these fluctuations here, we had multiple the typical price retesting multiple times the simple moving average over here. So these could be very useful for some intraday fluctuations, for some short-term entries, because we had that several long positions over here, long signals, bullish signals, but short-term ones, just to benefit on this rebound and shorten it at a higher level, or as soon as the asset the typical price close below the simple moving average. Some of the advantages and disadvantages. Weighted close is a more simple one, coincides views of the whole day. double weighted to closing prices, smooth data of the whole trading period. Also, one cannot use weighted close indicator to actuate buying and selling yet. It can be handy in determining the primary trend. So typical price indicator, it might be better for that purpose. It enhances smoothness and filters and it can be used as filter for various moving averages, including exponential moving average. Now, the disadvantage of weighted close indicator is the fact that the calculation counts the figure of closing prices twice, so that carries more weight on the closing prices, and that might sometimes lead to misleading signals on some occasions. So it doesn't provide always clear trading signal. Okay, I'm referring to the weighted close indicator. And it must be used with moving averages along with weighted close to determine the direction of the typical trend, similar with what we did earlier with the typical price one. Okay, last but not least, guys, I know that you're tired, is the shift. Shift basically is taking your existing moving averages but add a shift to it, so displayed it into the future or into the past. So if you don't want to make any test, if you don't want to change your system, you don't want to change your method, you prefer simple moving averages, or you prefer only exponential moving averages, you don't want to try a weighted close, you don't want to try typical prices, you don't want to try linear weighted moving average, and etc. That's fair enough. So you can try instead the shift. Basically, the shift is using again your moving averages. If you're using, for example, like what we do in our daily setup. Don't know how many of you are watching our, live streamings. Okay, I don't have it over here. Where's my template? The intraday one. Okay, here's the intraday one. I'm using the 5 and 9 exponential moving average in my intraday setup. Okay, so you can use your usual setup, but you can add shifts in order to have a shift to the future. Basically, a shift, okay, is the least important of the simple moving average settings, but what it does is just displaying the moving average in time. Okay, so with a positive value shifting, the simple moving average, you're gonna see a shift to the right hand side. You have a negative value over here, you're gonna see a shift to the left, so to the past. Shifting with negative value is only useful as a tool for looking at historical data. If you're looking for simple moving average for the current period with a negative shift, it is not possible. Okay, but if you want to display it into the future, okay, that will give you indication in advance. Okay, you give you an indication in advance for any potential change of the trend. Basically, displaying the moving average by several periods might help you to keep the prices above the moving averages, creating a better fit for the asset's trend and avoiding with this way any false signals. But also it could give you the indication of any shift, any potential shift on the existing direction of the trend. So better displaying moving average Canadian providing better reversal signals other than support and resistance, obviously. So this is an example. Crossover, bearish crossover, clear short position. Okay, so this is the default one with 0 shift, and this is the same the same one but with a shift plus 10. So it's giving us it's giving a shift to the future, let's say. Okay, if the gap between them stays the same, that indicates that this trend will stay as it is. It will continue in the same direction. But as soon as we see the gap between them getting squeezed until they clash, that's an exit level. Okay, that's an exit level. And plus, as soon as you see the move of the plus 10 one to be below the default one, that would be an entry to go long. And again, you need to measure the distance between them. If it doesn't get squeezed, if it doesn't get narrower and narrower and narrower, the narrower it gets, the more you are close to the end of the trend. The wider it gets, the more the continuation of the trend will be. Are you getting the meaning of it? Okay, so yeah. And they could also act as support and resistance levels like every other single moving average, displayed or not displayed. But with the displayed one, you need to make sure that that your trend is in alignment with those two, and that the gap between them is constant. But if it gets squeezed, if it gets narrower, that's an indication that we are at the bottom of the trend, at the end of the trend. That was pretty much it, guys. I'm gonna call it a day because we are nearly an hour and a half live. It's a very complicated complicated concept. We haven't seen the adaptive ones yet. Is it okay? If you are in an asset that maybe like oil or gold, that there are a lot of market conditions. The market conditions are changing rapidly. Adaptive moving average is an option as well, because it becomes faster and it's more adaptive to the changes in the market conditions. It swings more quickly in the direction of the price movements. During consolidating or non-trending market conditions, that adaptive moving average becomes slower or swing less quickly in the direction of the price movement. So this is an example of an adaptive moving average. This is this is an old dollar index chart. So it's a bit more adaptive, but you can see that there are many similarities. I mean, it could be also in this chart, instead of having multiple an adaptive and a simple one, we could have the weighted one, the linear weighted with the simple one. So it's the same mentality. As soon as we get seeing the adaptive one pointing towards the simple, that's an indication to that the trend is changing. So yeah. What's the best shift for the weighted moving average and simple moving average to pair with it? I'm afraid this depends on your time frame. So for example, here, This was a 4-hour chart, so the plus 10 shift was just fine. So you need to practice it and check based on your time frame, okay, onto our time frame and your actual price movement. Because you see, on that one, the exponential moving average that I applied was just fine. The default one was very nicely supporting providing a nice resistance to the price. So I only changed the shift to plus 10. It was just fine. Just go backwards in your trend and check whether a plus 10 or a plus 5 or a plus 15 will need it, or a minus. Okay, minus. You could also use a minus in this case just to have a support level, but to use it for multiple target areas. I forgot to mention that. So in this case, guys, you could have a minus 10. Okay, so another line here. Okay, another moving average here, a minus 10 one, that could provide not support, but multiple targets. Okay, so yeah, but I don't find that necessary in this case, to be honest, because you can just exit as soon as you see the asset. You can basically find your potential target levels based on the historical data, or just use the clash of the two moving average for closing your position. With this way, you will not suffer an early close earlier than what it should be, basically. Guys, I'm gonna call it a date. Thank you very much for attending. This is just some ideas of how you can advance your existing moving averages. Okay, some different settings that you can test and practice. Test and practice though. And if you find the appropriate ones, stick to it. If you find for euro dollar that in a 4-hour chart that you are existing exponential moving average work just fine, but you need to add another one with a shift, stick with that. Don't change it again. Just try multiple ones, find the ones that make more sense to you and they give you more accurate signals, and stick to them. Okay, I'm not referring to change all the time. No, try to see what gives you the best possible entry, the best possible exit, etc. And just stick with it and say, okay, for euro dollar in my 1-hour chart, weighted along with exponential, give me nice entry levels. Or for cable in a 30 minutes chart, the 5 exponential and the 10 shift also they give me nice exit levels and etc. So test, find the ones that make sense to you and use them and stick to them. Okay, have a great day ahead. Take care. A very volatile week ahead. We have NFP, we have FOMC tomorrow. Now the consumer confidence are about to release. I know that it wasn't an easy webinar. I know that, but only with practice you can understand the meaning of each of those moving averages. Only by applying them to your chart and see what each one of you of these, what gives you, what signals it gives you, you will understand what's the one that satisfies your strategy and which it doesn't. If it's something is too complicated for you, don't use it, don't test it, don't practice it. Okay? Have a great day ahead. Take care. See you again tomorrow. Bye-bye.